Hello friends, in this video I am going to cover the normal backwardation theory of pricing of futures contract in detail. So this is going to be a long video. So if you want to understand this theory in detail, please do watch this video completely. In the earlier videos, which are a part of this derivatives 301 futures contracts series, we understood that the spot prices are different from the futures prices because futures contracts are getting executed sometime in future, maybe 3 months or 6 months down the line. So the price expectations as well as other factors get built into the price at which the goods will get transacted in future. I have talked to you about 4 theories of pricing futures, and in this particular video we are going to talk about the theory of normal backwardation to understand why the futures prices are different from the spot prices. So broadly speaking, there are 4 theories or approaches that explain the differences between futures prices and the spot prices. The number 1 theory is the expectations theory, which talks about how the expectations of the commodity or the underlying asset in future drive the prices of the futures contracts. The second theory is the theory of normal backwardation, which I am going to explain in detail in this video. The third theory is the cost of carry approach. And the fourth is the integrated approach, which combines all these theories and therefore is more realistic theory or an approach. So let's understand normal backwardation theory now. It has been observed that in many markets, the short hedging is in excess of long hedging, which means that there are more people interested in selling the commodity or the underlying asset in future as compared to the number of people who are interested in buying that asset or commodity in future, which means the supply is in excess of demand. Obviously, as the law of economics dictates, when the supply is in excess of demand, the prices will tend to be lower. That is the fundamental equation underlying and explaining the theory of normal backwardation. In general, the producers of the goods who have invested the capital in setting up the plant, in setting up the distribution network, are worried about the prices at which they will be able to sell this in the future. So they would like to lock in at the prices which are near the spot prices and may be willing to accept a slightly lower price as well, which is fundamentally the reason why the normal backwardation exists in the markets. In some of the markets, the speculative volume is low. That is, there are less number of speculators and most of the players in the markets are genuine hedgers who are trying to protect against the risk of buying that asset or commodity in future or selling that asset or commodity in future. In which case, we see that the normal backwardation exists. Now let's understand the position of the two parties in the futures market and the spot market. The short hedgers are having a short position in the futures market, and that's why they are called short hedgers, whereas those short hedgers are typically having a long position in the spot market. That is, they may possess the commodity at that point in time, or they may be a producer who intends to produce that commodity by the time the execution of the futures contract has to happen. Now, the short hedgers are trying to protect themselves against the risk of fall in the prices of the commodity at that time when the futures contract is supposed to be settled. On the other hand, we have the long hedgers, or typically buyers. The long hedgers are so called because they have long position in the futures market. However, they have a short position in the spot market. That is, they do not possess the goods and therefore they want to buy those goods in advance at a future date at a price which is a future price. And therefore, these long hedgers are trying to protect against the increase in the prices of that commodity in future. Now, as I mentioned, the fundamental reason for existence of normal backwardation in the market is the short hedging, which is in excess of the long hedging. That is, there are more people trying to sell the commodity in future as compared to the number of people who are trying to buy that commodity in future. Now, why does this happen? This happens because typically the producers do not want to take the risk of the prices of the final commodity that they are selling falling in the future. They have already invested in the assets to set up their plant, to set up the distribution network and everything. So they are more worried about managing the efficiency of the plant, procuring the raw material, managing the technology component, arranging the logistics and so on and so forth, rather than speculate on the prices in the market. So what they would like to do is focus on the production and then leave the worries out about the prices of the goods in future. So they would like to lock in the prices at which they will be able to sell in future, to make sure that if they produce efficiently, and that's what they are good at, in that case they will make the desired margins and they will recover their cost of capital. So producers are more inclined to accept slightly lower prices in future to make sure that their margins are protected. Let's take example of agricultural products. Let's say wheat or bajra or maybe sugarcane. As we know, the production of the agricultural produce happens in 1 or 2 seasons, typically in India, whereas the consumption happens over a period of entire year. We consume wheat, bajra, sugar throughout the year, whereas the crop comes out typically twice in a year. So at that point in time, the farmers are worried about selling that crop and about the price that will exist when the crop comes to market. So they will be more willing to accept a slightly lesser price than the spot price to make sure that they are able to sell the crop at a reasonable price when the crop comes to market. This is why the normal backwardation exists. What is backwardation? Backwardation means the futures price being less than the spot price in the market. Let's say the price for a particular food item is 50 rupees per kg right now in the spot market. The farmer expects the crop to be ready next month. That farmer may be willing to sell at, let's say, 48 rupees to make sure that he is not making the loss when the crop comes to market, because at that time there will be more sellers and less buyers. The consumption is throughout the year, whereas the sellers are coming to market with that crop only twice a year and flooding the market with the goods or the crops. Now, because there is a backwardation, that is, the futures prices are less than the spot prices, the speculators enter the market to profit from this situation. Let's say today the price of a commodity is 50 rupees per kg. In the future, 1 month down the line, the price has to be less than 50 rupees in order for the speculators to be attracted to the market. What the speculators will do, if you offer them in future at 48 rupees, they will take the risk of buying in the future at 48 rupees. And if the price is more than 48 rupees, they will make the profit. So if the prices of the commodity are slightly less in future, the producers are able to attract the buyers or the speculators to make sure that they are able to sell their produce when it comes to market. Thus, the futures prices would generally be less than the expected price by what is called the risk premium. The equation is F is equal to E minus R, where futures price is F, a price at the future date, E is equal to expected price at that date, and R is the risk premium, the amount that the producer or the seller is willing to pay in order to make sure that he doesn't suffer from the risk of price decrease in future. However, it is not necessary that the normal backwardation will prevail in all the markets at all the times. For example, in non-agricultural commodities market, it is seen that there is a prevalence of normal contango also. What is contango? Contango is basically the futures prices being more than the spot price. Why does this happen? Because in that case, the production is throughout the years. In case of non-agricultural commodities, let's talk of steel, cement or oil. Whereas the consumption may be seasonal. The oil consumption goes up because in the winter there is a more demand for energy or oil. Hence, when the buyers want to lock in the oil prices in future during winter, they will be willing to pay higher prices instead of the producers being willing to sell at the lower prices. So normal contango might prevail in such cases as compared to normal backwardation. So the equation in case of the normal contango is going to be F is equal to E plus R, where F is the futures price at a future date for that particular underlying asset. E is equal to expected price at that particular date in future, and R is equal to risk premium. So the buyers will be willing to pay the risk premium in addition to the expected price at a future date to make sure that they get the commodity at a reasonable price in future. So To sum up the theory of normal backwardation, typically normal backwardation prevails where the futures price is less than the expected spot price in future. Why does this happen? This happens in cases where the producers are worried about the prices of the commodity going down in future. So they are willing to accept a slightly lower price than the expected futures price to make sure that they are able to actually sell the goods at a reasonable price. So they are willing to pay a risk premium. Let's say the expected futures price is 50 rupees per kg. They may be even willing to sell at, let's say, 49 per kg to make sure that they get at least 49 rupees instead of maybe getting 45 rupees if the price goes down in future. Therefore, this particular scenario exists in cases like agricultural produce, where the crop comes to market suddenly only twice a year, whereas the consumption is throughout the year. So when the crop floods the market, the farmers expect that the price might go down. So they may be willing to lock in at a reasonable price, which is even less than the expected futures price, to make sure that if the price goes down suddenly quite a lot because of excess supply, they do not end up making too much of losses. Now, we will understand a normal backwardation theory by taking a few examples from the market. Number 1, we will look at crude oil futures on CME NYMEX. Number 2, we'll look at Henry Hub natural gas futures on CME NYMEX. Number 3, we will look at steel futures on MCX. And number 4, we will look at aluminium futures on NCDEX. So let's go through each of these examples to understand how the normal backwardation theory of pricing futures works in reality. So first, let's understand the prices of crude oil futures on CME NYMEX. What we will observe is that the prices of futures contracts are more than the spot prices in the immediate period, next about 2 months. That is because in these 2 months, there are buyers who are looking for immediate delivery of the energy or the crude oil, because they need that. There is a shortage. Whereas in future, let's say from 3 months to 6 months, we find that the futures prices will go down. That is because the producers find that there is an uncertainty. They want to lock in at a slightly lesser price in the distant future, which is, let's say, 3 to 6 months. This explains how normal backwardation prevails where there is a uncertainty in the minds of the producers. The oil producers have invested huge amount, billions of dollars in exploration as well as in setting up the oil wells. So they want to make sure that at least a part of their production is locked up at a certain price in future. Otherwise, if the prices go down too much, they will end up making losses. So while the volume of the futures contract in 3 to 6 months duration is less, still they are trying to cover to a certain degree their risk of the prices going down. So in the immediate term, next 2 months, the buyers are very keen on getting actual delivery of the crude oil. Whereas in the distant future, that is 3 to 6 months, the producers are keen to make sure that their production at least partly is getting sold at a certain price to recover their fixed costs. Here on this screen, we look at the contract details for the crude oil futures. Each contract, as we can see, is 1000 and the price quotation is in US dollars and cents per barrel. The product codes on the CME NYMEX are given over there. There is a clearing code, etc. and also certain other things like the trading hours. Here on the screen, we are looking at the actual codes. We see that the price is increasing between July and August 2023. These are the snapshots taken in the month of June 2023. Whereas if you look at the prices for September, October up to January, we see that the prices are going down. In the next 2 months, the July and August months, the prices are, for example, the low prices are 67.51 and 67.67. So there is an increase in the prices. Whereas if you look at the prices starting September, they go down to 67.58, 67.41, 67.14, 66.82 and 66.81. Of course, the volume of trading of the futures contract right now is less. That is because only few players on both sides are interested in trading futures in these future months. So we find that in the immediate term, the prices are going up. in the slightly distant future, the prices are coming down. That is because the producers want to hedge their risk. Again, if we look at the settlement data, we find again, the prices are going down in future, which is September 23 to January 24. Whereas in the immediate term, July and August 23, the prices are going up. Here we can see the level of interest or the total volume getting traded. As I explained, the volume of trading in the immediate contracts, that is July and August 2023, is very high as compared to the volume of trading for the subsequent contracts, as is the normal in most of the futures contract across the world. Now let's look at Henry Hub gas futures on the CME NYMEX to understand how normal backwardation theory works. We'll find that the prices are going up in the immediate future, that is up to 6 months, whereas subsequently the prices are coming down. Also, in the subsequent months, there is a lower interest in trading, which, as I mentioned, is normal in most of the futures market. There is higher interest in the immediate months as compared to the subsequent months. So in the immediate futures, the buyers are keen on getting delivery of the gas, whereas in the subsequent months, it is the producers who are more keen on locking into some contracts to make sure that they do not suffer excessive losses if there is more supply than the demand in the future months. So they are willing to accept a slight amount of risk premium and accept the low prices for the futures contracts. So on the screen, again, the contract specifications are given. So contract unit is 10,000 BTU. The price quotation is in US dollars and cents. There are different product codes for clearing and settlement. Trading hours and other details are given over here. Here in the settlement screen, we can see that there is a price increase for settlement happening for about 6 months. So price is moving from 2.266 to approximately 3.662 in the 6 months. But thereafter, for the next 3 months, February 24, March 24 and April 24, the prices are gradually moving down, which means that the producers are looking at hedging their risk of the prices going down in the months of February, March and April 24. Now one thing we have to note is that those are also the months after winter, right? So the energy demand will go down. So both the theories are working together, the normal backwardation theory as well as the expectations theory. Again, these are the volume details. So as you can see, the high open interest is there for the contracts for next 6 months as compared to the 3 subsequent months of December, January and February 2024, which is natural in all the markets. Now, let's look at steel futures on MCX and aluminium futures on NCDEX to understand how normal backwardation theory works. As you will observe, the volume of trading as well as the contracts are less on these two markets in India because the commodities markets are typically global markets, and the volumes on markets like the NYMEX are pretty high as compared to volumes in India. We'll observe on MCX as well as the NCDEX also that typically the producers are willing to accept the lower price for these items like steel and aluminium in the near future as compared to current prices. That is because they want to hedge against the risk of decrease in the prices in future, which is what is called normal backwardation theory. Now this is a NCDEX screenshot. You can see that the lower prices are expected in June and July 2023 for the long steel. So prices are 46,180 and 46,010 as compared to the latest traded price. These prices are higher and the spot price is even higher. So as against the price of about 47,300 on this day, the producers are willing to accept 46,180 and 46,010 in the subsequent months. Now here on this screen, we can see the futures contracts for aluminium. We can see that the lower price is being expected in the month of July as compared to the month of June. That is because again the aluminium producers are trying to hedge against the risk of the prices going down in future. So they are willing to pay a slight amount of risk premium and lock in on a certain price in advance. So we took number of examples from real life in various commodities like natural gas, crude oil, steel and aluminium to understand how normal backwardation theory works. That is why producers are willing to accept slightly lower price in future as compared to the expected spot price in future. But we have to understand one thing. Normal backwardation theory is just one of the theories of pricing futures. This theory works along with the expectations theory and cost of carry theory. The expectation theory, as I have explained in the previous video, is about the expectation of the price in future. We saw in case of the gas contract, for the next 6 months, the prices are going up. That is because the winter is approaching. So both the producers as well as the consumers expect that the prices will move up. So for 6 months, the prices are increasing. Post-winter, both the producers and consumers expect that because the demand for the gas will go down, the prices will go down. So that, along with normal backwardation theory, makes sure that the prices are going down after winter. The cost of carry theory, which I'll explain in the subsequent video in more detail, also is working in this case to make sure that the producers get at least some minimum premium for carrying the inventory on behalf of the buyers. So I hope in this video you understood normal backwardation theory in detail, why the normal backwardation happens from the producer's point of view. Also, we took 4 or 5 examples to understand whether normal backwardation theory is observed in reality or not. If you found this video interesting and useful, please like and share. Also, through your comments, let me know if you have any questions so that I can clarify them. Thank you very much and cheers.